Hi, Jim Gore from THOR Wealth Management. A lot of people are comparing this market to 1999, and there's good reason for that. If you look at this chart here, this is looking at what is known as a cyclically adjusted PE ratio, price earnings ratio, or known as a CAPE ratio. And you can see here that the market today is higher than what it was in 1929 before the peak, and just slightly below 1999. And we talked about the overvaluation of the market in general with the THORDEX, and that's why people are comparing it to 1999. However, there are some significant differences, and we think that what I would compare this market is partly 1999, partly 1970s. And the big difference that we see is in the fixed income market. Back at the end of 1999, the 10-year Treasury yield was 6.43%. The Fed's funds rate was 5.5%. Today, the 10-year Treasury is 1.33%, and the Fed funds rate is 0.25%, basically 0% interest rates. So the Fed is still pumping the market and adding liquidity to the market, and this is what's causing an inflation. We're seeing it in real estate, we're seeing it everywhere in the market, and we're seeing it in high equity values here in large companies in the United States. The big difference is inflation. The inflation rate back in 1999 was only 2.26%. So your real yield, when you were buying a 10-year Treasury, you were getting 4.2% on your money. Today, the inflation rate is 5.39%. And so you're getting a negative yield of 4%. So the comparison of 1999, you can talk about it from a valuation perspective, but what's more important, we believe, is a comparison to the late 70s in an inflationary environment. We think we're at the early parts of the 70s because the Fed did keep rates lower too long back in the 70s, and we're starting that process now. And because of that inflationary environment, the Federal Reserve is probably going to have to raise interest rates higher than they should do in order to tamp down inflation like they did back in the late 70s. So this is why we like other assets besides U.S. large company stocks. So inflation is number one area, but the other area that's different from 1999 is 1999, the market was expensive in just a few stocks. The overall market was not expensive. Small companies were cheap. And if you look at this chart here, other aspects of the market were cheap. This is the S&P 500 equally weighted index compared to the market cap the weighted index, and it's looking at enterprise value divided by sales. So if you look at this, the dark line, that's just the market cap of a weighted S&P 500. We're above where we were in 1999, but look at the equally weighted index. It never had the jump up in 1999. You could find stocks, large company stocks, that had lower market capitalization weighted in the S&P 500 that were selling at very good prices. And if you did that, you held up very well in the correction from 2000 to 2002. Today, that is more than 2 times what it was in 1999. So what this is saying is the U.S. stock market, large company, is completely overvalued. It's very difficult, and we're having a very difficult time finding individual stocks to buy in U.S. large companies because of this valuation. So where we are at THOR, because of inflation concerns that we have, and because U.S. stock market, especially U.S. large companies, is overvalued, we are investing a lot of our money in pipelines, hard assets, and also international, especially emerging markets, because those aspects would do well in an inflationary market, and they're going to do well compared to U.S. large companies because they're not overvalued as U.S. large companies are today. If you have any questions or concerns, always feel free to reach out to us, and we look forward to talking to you in the next couple of weeks. Take care.